Hi there, welcome back. Today is the day of market risk. We will see together that in the Basel framework there are essentially two different approaches that we can use to assess market risk. One is the so-called historical simulation approach, and the other is the model building approach. We will see that in both approaches, nevertheless, the most important risk measures that we will use are the volatility risk and the expected shortfall. Now, let's now say something about market risk. Market risk, together with credit risk that we covered before the holidays, is one of the main risks that we find in the Basel framework within the first pillar, in the minimum capital requirements. Now, market risk, if you take the definition of the Basel Committee on Banking Supervision, is defined as the risk of losses in and off balance sheet positions arising from movements in market prices. That is to say, we have our portfolio and we expect losses in the portfolio because of changes in the prices, that is to say, in the values of the underlying market variables. The underlying market variables are objects that by now we know. So it's obviously the price of an asset, but it can also be the interest rate, it can be the exchange rate, it can be the volatility, and so on. So you can expect that in the market risk framework, tools like the Greeks can be used. And actually they are used in one of the two main approaches, which is the model building one. But if you consider what are the most important risk measures that we actually use in market risk, these are prescribed by the regulator, and these are two that we know very well, the volatility risk and the expected shortfall. Now, to deal with volatility risk and expected shortfall, we know that we need essentially one object, that is the fundamental object on the basis of which we can compute the VaR and the expected shortfall. That is to say, the loss distribution. Now, in the Basel framework, there are two main approaches, simplifying a little bit, to generate, to obtain a loss distribution. And from the loss distribution, we will then compute the quantities of interest. Now, the two main approaches are the so-called historical simulation, and the other one is the so-called model building. The two approaches differ from a very basic thing. In the historical simulation approach, we have a completely data-driven approach in which we use past data to generate what we will call scenarios, and on the basis of the scenarios, we will derive the loss distribution, then the volatility risk, then the expected shortfall. In the model building approach, conversely, we don't use market data directly as sources of our loss distribution, but we impose a model. We have maybe a theoretical model, we have a theoretical construction that we use, whose parameters can be estimated using real data, that's for sure, but loss distribution is essentially a theoretical development. In this framework, we will see that the main approach we will consider is the so-called variance-covariance, the VaR-Cov approach, in which we assume, once again, normality. It's not the only one, but it's for sure one that is highly used in the Basel framework and highly criticized in the Basel framework. Now, let's start with historical simulation. Historical simulation is extremely simple. So there is nothing complicated in historical simulation. It's just a long and boring exercise. Nothing more, nothing less. If you find a financial guy saying, you know, I've been performing historical simulation, and he's just been performing just a boring task, nothing particular, interesting from a conceptual point of view. It works like that. We use past data to generate the loss distribution. Now, this approach is simple. It's relatively quick, so the difficulty can be in the length of the simulations depending on the amount of data, but conceptually it's very simple, and it's very simple to understand and implement, and it's used by most banks. In reality, even if, in principle, they could choose between one of the two approaches, historical simulation and model building, most banks use a combination of the two, according to the prescriptions of the regulator. Now, suppose that we want to compute the 99% valid risk of a portfolio, of a market portfolio, with a one-day time horizon. Now, these numbers I have just chosen are not just random numbers. These are the de facto standards in the industry. In the Basel framework, you are prescribed, if you are a bank, to compute the 99% one-day valid risk for what concerns market risk. So, in computing the value at risk, you want to play with the daily loss distribution of your portfolio. Why? Because you imagine that if you have a market portfolio, the variations that you can expect in the different market variables are, for sure, much more frequent than the variation that you can have in a credit portfolio of mortgages. We have seen that in credit risk, typically the time horizon is 1 year. It can be different, but let's say that on average, it is 1 year. In the market risk framework, it's 1 day. And the 99% valid risk is one of the compulsory levels that you have to compute. Other levels are, for example, the 99.9, which is called the worst case scenario level. Now, we need data. If I'm a bank, can I use all the data or the amount of data I want? Yes, provided that you use at least 501 days of data. Why 501 days? Because in commercial years, this is roughly 2 years, so you need at least 2 years of observations from the past that you can use to generate your scenario. Why the 1, so 501? Because you will see that thanks to the very simple technique we will discuss in a minute, with 501 observations, I can generate 500 scenarios because I lose one observation in the transformation. So I need at least 501 so that I can generate 500 scenarios, which is roughly 2 years. If you want to use more, other common numbers are 600 and 1000. 1000 is more or less 4 years. And in fact, in market risk, when you use the historical simulation, you need from 2 to 4 years of data. Okay? Now, how does it work? The first thing that you have to do is to identify what are the market variables that impact your portfolio. And these are the quantities that we know. We will see a very simple example together with Excel. So for what concerns historical simulation, you can expect that I can ask you how it works. I will never ask you to generate scenarios by hand on your exam paper. So once you have identified what are the most important market variables that impact your portfolio, the prices, the volatility, and blah, 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 you collect data about these variables. And you do that on a daily basis. Obviously, you are a bank that has been operating on the market for several years. In principle, should not be a problem to have this data. It can be a problem if you are a new bank. See that a new bank coming on the market because it was just funded yesterday. In that sense, there are situations in which you can acquire the data from third parties, or you switch to the other approach, which is the model building. Let's just say that we call day 0 the first observation that we have in our data set. And with first observation, we say the most distant one in the past. Okay, so if today is, I don't know, what is this, January the 7th, we go back 501 days, and that will be what we call day 0. Then day 1 is the next one, day 2, day 3, day 4, and so on. The first scenario, what we call scenario 1, is the scenario that we generate by looking at the daily percentage variations in the market variables between day 0 and day 1. Scenario 2 is the one corresponding to the daily variation in percentage in the market variable from day 1 to day 2. So you see why we need 501 days in order to generate 500 scenarios. Once we have these scenarios, you will see that it's very simple to generate a loss distribution. And once we have generated our loss distribution that assume is something like that, what we do, we compute our valid risk, and then we compute the expected shortfall. That will be the average of the observations above the valid risk. Very trivial thing, because I remember that in one of the code questions, a significant number of people answered wrongly. The valid risk is a number, okay? It's a quantile, and tells me what is the probability of, for example, the 95% valid risk is the value such that 95% of the losses are smaller and 5% are larger, okay? The expected shortfall at the same level, 95%, would be the expected loss above the 95% valid risk. So by definition, the expected shortfall at a given level cannot be smaller than the corresponding valid risk. It's an average of the losses above. So it's above, needs to be larger. In principle, in very strange situations, very strange portfolios, it could be equal to the valid risk, because assume that you have a distribution that puts 5% mass on the valid risk because of some discrete component. In that sense, the expected shortfall will be the valid risk, but it's a very strange situation that probably just exists in the exercises of some math professor. In reality, the expected shortfall is always larger than the valid risk, but at the corresponding, obviously, confidence level. If it is different, it's not guaranteed. Okay, once we have the loss distribution, we compute the valid risk and the expected shortfall. Now, let's see how it works. Let's say that today, so today, January the 7th, it's day n. We call that day n. What we want to do is to generate 500 possible scenarios for tomorrow. That would be day n plus 1. And how do we do that? The height scenario, that is to say, the scenario generated under the height percentage change in my portfolio, is given by Vn plus 1, the value of tomorrow, is equal to the value of today, Vn, multiplied by the change that I observed between day I minus 1 and day I. So it's very simple. Imagine that today our portfolio is, I don't know, the value of our portfolio is 110, okay? And this is a day n. Now, if we go back, we know that we can go back to day 0. And then we have, for example, day 1. The first scenario is given by the variation between day 0 and day 1. Now, let's assume that day 0, the value of the portfolio was 100, okay? And that in day 1, it was 101. Now, what do we have? We have to take 101 divided by 100, and that will be the daily variation under the first scenario. This daily variation is what? Is 1%. Okay? So we have a 1% variation. And now what we do is, if we want to generate the possible value of our portfolio tomorrow under the first scenario, we multiply this by, so we generate the scenario under the 1% increase. So that will be 1.01. So that, what do we expect tomorrow? The 1% of 110 is 1.1. So tomorrow, what we expect a portfolio which is equal to 111.1. Okay, that will be the value of our portfolio under the scenario 1. If I want to generate scenario 2, I will have day 2 here. I will take this variation, that will be scenario 2, and assume that the variation that I obtain here is like a loss of 2%. A loss of 2% means that I have to multiply 110 for 0.98, and so on. So I can generate different values of the portfolio. If I do that, and then I compare this value with this value, so the value I predict for tomorrow under the first scenario and the value of today, I see that there is an increase in the value of the portfolio. So under the first scenario, my portfolio generates a profit. But under the second scenario, in which there is a decrease of 2%, my portfolio will generate a loss. So combining these 500 scenarios in this way, I can generate 500 different values of my portfolio. That is to say, a combination of profits and losses, likely depending on what were the performances of my portfolio in the past. Once I have this combination of profits and losses, I have a loss distribution that I can approximate empirically using something like the histogram, the kernel density, whatever I want. I get my empirical loss distribution, and then using what we have seen with the volatility risk at the very beginning of the course, I can compute the volatility risk and the expected shortfall. So I compute my empirical cumulative distribution function, compute the volatility risk, compute the expected shortfall. Now, the problem, as I was anticipating, is that if I have historical simulation as my main approach, I need data. So if I don't have data, if I don't have at least 501 days of data, I can, and I cannot acquire those data from someone else, what I can do, I can increase the data I have, assume that I have 400 days. There are statistical techniques of data augmentation, like, for example, bootstrap and jackknife, that I can use to increase the number of observations. Here, the regulator will decide if I can do that or not. Okay, if I just need 10 extra observations, you can safely use those techniques. If you have 3 observations and you want to generate 500, obviously you are not allowed. Otherwise, what you do, you move to the model building approach. Now, once I have computed my volatility risk in this very simple way and the expected shortfall in the same way, what can I do? If I go in the Basel framework, I will find a set of formulas like this, for example. In this formula, you see that the argument is always the VAR. In the first case, I totally don't care about this formula. Okay, it's one of the many, just to let you understand why we compute the volatility risk. Assume that I have my volatility risk computed. This formula tells me that if I want to compute the capital requirements, I have to take the maximum value between the volatility risk at the 99% level on a daily basis that I have just computed. That's the first, the VAR 99 t minus 1, and another quantity, which is MC. MC is a parameter given by the regulator, so it can be 1, it can be larger than 1, it can be smaller than 1, but it's a number that you read from the regulator, so nothing that you have to compute yourself. And the average of the VARs that you have computed in the last 60 days. Okay, so every day you compute the volatility risk on a daily basis, and then you take the last 6 days of your computations and you take the average. That's the first part. And you take the maximum of these 2 quantities. The second part is essentially the same stuff, but the volatility risk is substituted with a quantity that you have found in the book by Hall, that is to say the stressed VAR. The stressed VAR is no longer, because we are in almost Basel 4, but it was a novelty introduced in Basel 2.5, and it's the idea of taking the volatility risk by looking at those days of particular stress for the portfolio. It's usually computed in this way. Instead of taking 500 days of observations and considering all the observations, you take your 500 scenarios, so you can generate your different losses and profits, but you only select the worst ones. So of the 500 values that you have considered, you just select the worst ones, that is to say typically the losses, the higher losses. And you take the volatility risk at that level. So you compute the 99 valid risk only on the worst losses. So that is what we call the stressed VaR. So instead of using 500 observations, you will use 250 observations. It's an artificial measure that should, in principle, take into consideration the situation in which something goes bad for your portfolio on the basis of what you have observed so far. Now, once you have that number, then you go on with your risk management work, which is at that point essentially to find a sufficient amount of money to cover for that number, because these are the amount that you have to put as a reserve. So if you don't have the money, that you have to liquidate your asset and blah, blah, blah. Now, the valid risk, and this is extremely important here in the market risk framework, the valid risk is something that we know is not coherent. The guys in Basel discovered that after the crisis. Actually, it was something that they should know in advance, but it happened. Okay, that is what we know. But the fact that the valid risk in general is not coherent is not the only problem of valid risk. A very important problem, probably even worse than not being coherent, is the problem of procyclicality. It's not a problem of valid risk per se, so it's not that valid risk per se is procyclical, but it is a problem of the valid risk in combination with the rules of Basel. So at the end of the day, the responsibles are always in the Basel Committee. Now, it works like that. Thanks to the valid risk, we compute the capital requirements using a formula like this that we have seen, or other formulas. But it's always like that. You input the valid risk, you get the capital requirements. Now, imagine that you are a bank, and at a certain point, there is a crisis on the market. A typical sign of crisis on the market that generates difficulty for banks is when volatility increases on the market. Now, if volatility increases on the market for a substantial period, I'm not speaking about 1 day, 2 days, but for a certain number of days, you see a relevant increase in volatility, what do you expect for your loss distribution? Your loss distribution will tend to be more dispersed, okay? Because volatility is a measure of the dispersion of the observations in our data set. If volatility increases, the loss distribution becomes more dispersed. So maybe instead of this, it becomes something like this. And if I compute the valid risk at the 99 to 95%, the 99% level is no longer this one, but maybe is this one. So instead of being, I don't know, 1 million, becomes 5 million. But if the valid risk increases, and you plug in this new number in your formula, what you have is that the capital requirements increase. Okay, you have a higher risk as perceived by the valid risk, so your capital requirements will go up necessarily. If you don't have enough money, enough funds to cover for those new capital requirements, what do you have to do? You have to liquidate some of your assets. So you take some of your assets, you go on the market, you sell them. Now, if you are the only bank, if we are the only bank doing that in the Netherlands or in Europe, who cares? It's not a big problem. You will go there, you will sell your asset, you get your money, and everything is fine for you. But during a crisis, it's very likely that you are not the only bank doing this. If it's a crisis, it's because it's a systemic crisis. Otherwise, it's just your problem. It's not a crisis for the system. If it's a crisis for the system, so if in the Netherlands the economy starts going not particularly well, the Dutch banks will start having problems. So they will start selling their assets in order to compensate for the increase in the capital requirement. But what happens if a substantial number of banks sell their assets on the market? The volatility on the market increases necessarily because you have more agents trying to sell. So the volatility on the market increases. If the volatility on the market increases, the value at risk increases. If the value at risk increases, the capital requirements increases. If the capital requirements increase, then what happens? You have probably to liquidate more assets, increasing volatility again. So you enter in this spiral, which is what we call procyclicality. Procyclicality in economic terms means that the variation of a measure, in this particular case the value at risk, impacts the system in a way that loops back to the measure, inducing a further increase in the measure. Okay? And you go in this way over and over again. So this is not a problem, I repeat, of value at risk per se, but it's a problem of the value at risk in the formulas as given by the Basel Framework. And it's a very important problem. So it can generate quite some dramatic scenes on the market if it starts. Another problem of historical simulation, which is more related to historical simulation, is the fact that it's historical by definition. So you are using past data, and you're using more or less the last 2 years up to 4 years of observations if you use 1,000 scenarios. But if you're using those past observations and you're using those observations to generate your scenarios for tomorrow, implicitly you are telling that the past for you is a reliable predictor of the future. So what will happen tomorrow is essentially what already happened in the past. This is the problem of historical bias, because we know very well that on financial markets this is not true. It's not that since something has not happened before, it will not happen tomorrow. Okay? So stress VaR tries to compensate this by drawing darker scenarios, by taking all the worst losses, but most of the time this is not enough. And historical bias is a very serious problem in finance. And it will become an even more serious problem with machine learning, because a typical weakness of machine learning techniques is the fact that they over-rely on the observations. And if something is not in the observations, it does not exist for the algorithm. Okay, so there are tools to compensate these, but we are at the very beginning. So most machine learning algorithms that are out there and they are used totally ignore the problem of historical bias, and they can generate very peculiar, if not dangerous, results. So there is a lot of discussion on this, also from the side of the regulator, obviously. The typical image I like to use is this one. You have a guy that is trying to predict the future with looking in a telescope that looks back, okay? So, or driving a car just looking at the rear window, the rear mirror. It can work for a little bit, not in general. So please remember, it's not just a problem here, it's a problem of statistics. The fact that historical bias exists, and you should take care of that. This does not mean that you don't have to use past data, otherwise there is nothing that you can do. You can use past data in a clever way. So be aware of the problems of doing that. In the approach that we have just considered, all the scenarios that we have generated, so scenario 1, scenario 2, 3, 4, 5, and up to scenario 500 are equally likely. So we are not saying that this scenario is more likely than these, or this is more likely than this. We are saying that they all have the same probability. There are situations in which this is not necessarily true, and it can be a strong assumption, so we can introduce weights, as we did, for example, when we were discussing volatility and moving from the simple average of the last observations to considering, for example, weighted observations. So looking at, thinking that what happened on the market yesterday to compute the volatility today is more important than what happened 20 days ago. We can do the same here. So we can introduce weights of different form. A very common weighting function is the one that you that you consider there. You define a value lambda, that is the weight that you want to assign at a given scenario, and then this type of weight guarantees that there is always a proportionality in the weights that you're assigned to all the different scenarios. In principle, what you do, you consider the observations that are closer to you as more reliable of what you can expect tomorrow with respect to what happened 500 days ago. Another way of weighting the observation can be, for example, to introduce also the volatility. So you compute weights that include the volatility. Why? Because we know that losses and profits are strongly related to the volatility on the market, and so you introduce volatility in your computation. But these are just some extra sophistications, nothing particular. You see, it's just changing the formula, so computing that is extremely trivial once you have the data. Now, let's consider very quickly an exercise just to show you how it works. We're using the same data that are in the book by Hal. You can find my Excel file on Brightspace if you want. It's just to understand a little bit better how it works, but nothing more than that. You're not supposed to use the file during the exam. Assume that we have a portfolio, and we are using the data of the book. So this portfolio is essentially a portfolio consisting of investments in 4 different stocks, indices. We have the Dow Jones, we have the FTSE, we have the CAC 100, and we have the Nikkei. Okay. The value today of the portfolio is $10 million, and we have, for example, 4 million coming from the Dow Jones, 3 million from the FTSE, 1 CAC 100, and 2 million from Nikkei. These data are quite far away in the past with respect to today, because they start in August 7, 2006, and they stop in September 25th, 2008. That, in our simulation, is what is today. So today for us is September 25th, 2008. These data can be interesting because they include, for example, the day in which Lehman Brothers defaulted. And if you want to play a little bit with this data, if you are interested, you will find them in the Excel file. Now, the first thing that we have to do is we have to generate our valid risk, our expected shortfall, but these are indices in different currencies. For example, CAC 100 is in euros, Nikkei is in yen, we have dollar, pound, and so on. So what we have to do is to find one currency that we want to use. Let's assume that we want to use the dollar. So all the quantities that are not in dollar need to be transformed into dollars. How? You apply the exchange rate. You should apply the exchange rate of the day that you are transforming. Okay, so when you are on September 25th, you will use, and you are under the first scenario, you will apply the exchange rate of those days. Okay, so you make that, and now you have the 4 different indices all expressed in dollars. Let's see how it works in Excel. It's very simple. So these are the data. So you have day 0 up to day 500. That would be today. So if you go down to day 500, you will see that is September 25th. And then what I want to do is, using these data that I have from my portfolio, from the Dow Jones, FTSE, CAC 100, and so on, I want to use, obviously, the quantities expressed in dollars after the conversion using the exchange rate to generate my scenarios. So what I can do, I can go in the second spreadsheet, and there I can, again, let me zoom a little bit. You see that the first scenario for the Dow Jones is obtained in this way. So I take the value of my Dow Jones investment in September 25th, 2008, and I multiply that value by the daily change I observed from August 7, 2006, yes, to August 8, 2006. That would be the value of Dow Jones in my portfolio under the first scenario. I do that also for FTSE and all the other indices. I combine all together according to the composition of my portfolio. It means that my portfolio tomorrow, so on September 26, 2008, under the first scenario, will move from 10 million, these are quantities expressed in thousands, from 10 million to what? To 10 million, 14,000 something. So there is a loss of minus 14,000 because it's a profit. So for us, it's a negative loss. Okay? Under the second scenario, there is a profit of 27,000 and so on. For example, in the third scenario, under the third scenario, I generate a loss of 53. And I can go on and I found that there are days in which I can have a much more substantial loss. If I remember correctly, the highest one is something very close to $500,000 in a day. If I put everything together, I can have a very simple representation of my loss distribution using the histogram. This is very trivial representation. I can have more sophisticated things. Personally, for example, I would try to smooth a little bit with some kernel, but okay, that's more fun. It's more than okay to understand. This is my loss distribution. Once I have my loss distribution, I have to compute the valid risk and the expected shortfall. If I go and I just show you the case under the simpler situation, the equal weights, if you want to see what happens by introducing weights, you will have all the other pages that you can surf. Imagine that I want to compute the 99% valid risk. There are different ways that I can use. The first one is what I call the naive one. The other one are the statistical ones. The statistical ones just is exploiting, in this case, Excel. If you have Python, if you have MATLAB, if you have R, or whatever you want, if you have your grandfather, to compute the valid risk. So here, for example, we use the quantile function, the percentile function of Excel, and we say Excel that I want the 99% percentile or quantile, they are synonym. This function, and I have to tell Excel if I want to include the last observations or not, these are just the statistical flavors, and I get values. The naive technique relies on the fact that in this very simple approach that we are using here, we are giving to all the scenarios the same weight. So remember that this is the situations in which all the scenarios have the same probability of happening for us. So how can I compute very quickly the 99% valid risk? The 99% valid risk is the observation such that only 1% of the observations are larger than equal to. Okay? So what can I do? I can rank all the losses from the highest to the smallest. So the highest is the loss of, so it's higher than what I was telling you. It's a loss of 470,000 and so on, to the lowest, which is the highest profit. And since I only want 1% of the losses to go there, what I can do, I can compute what is the 1% of 500 observation. It's 5. So it means that under this very simple approach, only 5 observations would be larger than the value of risk I'm looking for. So I just count 1, 2, 3, 4, 5, and I find that that observation is on line 6 there, because obviously the first one is the title, and that quantity is 253.38. Okay? So it's naive because I'm just counting the observations. I have 500 observations. The top 1% is the top 5 observations. If I would be interested, for example, in the 98% valid risk, I would have to take the top 2%. And the top 2% of 500 would be counting up to 10, and so on. Okay, and you see that exactly that naive approach corresponds to the second statistical computation, which is the one including the last observation, while the other excludes and go down and then interpolates. If I want to compute the expected shortfall, since all these different scenarios are equally likely, it means that the probability of each one of those losses is always the same. I can just compute the arithmetic mean of the observations above the valid risk. And that will be 327. Please notice that I can compute the arithmetic mean like this without weights, because the assumption is that the weights are all the same. You remember from what we have done with the expected shortfall in a more general framework that this is not necessarily true, because the different scenarios may have different probabilities. And if they have different probabilities, we have to take that into consideration. Just computing the arithmetic mean would be wrong and possibly dangerous for our computations. In the second row, you see the computation at the 95%. The 95%, it means that I have to take the top 5%, the top 5%, I have to count 25 observations, okay? And you will see that it works like that. If I want to correct for the standard deviation, so the volatility, if I want to introduce the weights using the lambda method, you find everything in the different pages of this Excel file. My suggestion, just spend 2 minutes, you don't need more, on this file to see if you have correctly understood how the historical simulation works. So, typical question, how is the historical simulation performed? And what you have to say, it's performed using historical data. We need at least 500 scenarios, so it means we need at least 501 days of observations. Then we compute the daily variations. You can write down the formula if you want, or just explain the formula by words. And then we apply the daily variation to the value of today of our market variable. Here we are just considering prices, but you can also consider all the other quantities. And I generate values that I compare with the value of today of my portfolio. I see if I have profits or if I have losses. I collect those quantities. I sketch distribution of losses. And based on that, I can compute the valid risk and the expected shortfall. Very simple. Okay, so we can stop for the break.